Hi everyone! What options trading strategy make consistent money or at least have a higher probability of success? 90% of the traders lose money. 90% of the options buyer lose money. So who makes the money? Option sellers make money, everybody. Institutions know that. Professional traders know that. They make weekly income, monthly income, quarterly income. We are going to dive deep into a trading strategy called the credit spread, the vertical spread. This will help you with 70% chance of success to make consistent income that you can reuse. Take that money into long-term investing in your retirement account and do the compounding strategies from Warren Buffett, Charlie Munger, Peter Lynch, and you buy and hold forever in those accounts, until you withdraw at retirement. So let's go deep into the vertical spread. So I'm super excited to go over the vertical spread, credit spread, option strategy. It's one of the most powerful option strategies that you can find in terms of probability of success, especially for the retail traders. So without ado, let's start. We're going to progress in the discussions with options trading basics. After, we are going to show and prove why selling options is the best strategies that the professionals are doing on a consistent basis, and how you can make money 3 ways. So, first exciting part. A credit spread is an option strategy that is not at the money. So, let's take a pen here, okay? So let's say that brand line is the current price on Apple, $170, right? When you trade here the stock at the current price, or you buy a call or you buy a put, it's called a directional trade. And those trades, you have a 50% chance of success. So this is kind of like a coin toss. You throw a coin, 50-50. You don't have an edge. Now, if you have good support and resistance, let's say you have a huge resistance that we use in our Full Pro tool or retail tools. Let's say the retail tool shows you resistance on Apple is 190. So whatever resistance you use, I'm just using our automations, right? So let's say you have a resistance at 190 and let's say you have a support at 140. Then there's a much powerful strategy. It's called the credit spread. And what the credit spread is essentially is a strategy of two-legged trade, and I'll show you how to construct a credit spread. But I want you to understand the logic at a very basic level. The strategy is a bet within a range that says, I bet that within a certain amount of time, the expiration of the options, we are going to stay below the 190, even though it's currently trading at 170, or staying above the 140. So if you do one call credit spread at the top here, call credit spread, at the 190, let's say 190, 191, so you sell the 190, you buy the 191 call, that's called a call credit spread. And so you would make money 3 ways. That's where it's very powerful. By staying below your assumption of a resistance. If the stock goes up, but stay below the 190, guess what? You make money. If the stock goes below the 170 and below the 190, you make money. If the stock goes sideways, doing nothing, neutral, you make money. So long it stays below the break-even of 190 plus the credit. So I'll show you the break-even, I'll show you the max profit, the max loss, the break-even, and how to structure a credit spread. But right now I want you to understand that this is an awesome strategy, the vertical spread, options credit spread, and this credit spread allows you to make money whether the market goes up, again, down, sideways, below your resistance, and above your support. That's all you have to remember right now. Now, let's look at something very deep. Who makes money when you trade option strategies? So let's go over 101. Let's say I buy an option. Let's say I buy a call option on Monday on the weekly options, on Apple. Let's say I buy the 170 call. And I buy this 70 call for $1. So you got to understand that options have three components. When you look at options and option strategies and options, you got to understand the 101 here. And because if you understand that, you'll understand everything. You'll understand credit spread for option strategy, iron condors, iron condor butterfly. So, and you'll understand all the ways to make weekly and monthly income with over 68% chance of success. Because all we do is probabilities. So if you do a directional, I told you have a 50% chance of success. Now look what we do here. We bump 68 to 99% chance of success with credit spread if you have the right support and resistance. This is why I've dedicated all my life, in trading for the past 24 years, creating tools, support and resistance, some of the best in our industry for stock investors, but also the options trader for income and directionals, but mostly income because that's where the money is. So let's go back here on the example. If you buy this option for $1 on Monday, so this is Monday, you arrive on Monday, and this option is going to expire Friday. So Friday is the weekly expiry in this option. An option, what you have to understand, the $1 options has three components. It has real value above the strike price. It has something called the time value or the decay in the options, and it has the implied volatility. So let's say we break, for example, this $1 options, and I'll take other example and show you real money accounts examples on the credit spread and the vertical spread. So let's say on this $1 options, the real value of this options is 20 cents. The time value is 60 cents, right? And the implied volatility then will be 20 cents. 20 cents plus 60 cents plus 20 cents equal the $1 that you pay here. But you really have to understand, until you don't understand that there's real value, time value, and implied volatility in an option, it really gives you a clue that you don't yet understand options. So this $1 option on Friday, guess what? How much is it? I'm the buyer of the option. Let's say that the real value stays the same, 20 cents, same on Friday, right? But here's what happened. Time value at expiration goes to 0. That entire 60 cents on my asset is gone. And let's say the implied volatility stays the same, 20 cents. Look how much my option is worth on Friday. On Friday, my options is worth 40 cents on Friday. I lost 60% of the value of my asset. And actually, it's not even an asset of my investment, because I cannot even call an option an asset, especially a long option. I use options for income to reinvest in my long-term portfolio, my stock investing, Warren Buffett, Charlie Munger, style, Peter Lynch style. So, but I use that income, weekly income, monthly income to create income. You can even help. This income can even help you pay the bill. So who made the money here? Someone knows the trick here, that you can buy options, directional options at $1, and they are worth 40% to 20% of what they were worth on Monday, on Friday. That's called the time decay. The time decay here is very, very important. So who made the money? The guy who bought the option on Monday for $1 that is worth 40 cents on Friday, or the person who sold it to you on Monday for $1. And this should be a clue right there. This is why 90% of the directional options, the calls, the puts expire worthless, and 90% of those guys lose money. Because the people who make the money are the option sellers. Institutions sell options, professional traders sell options. Our community sell a lot of the options. 80 to 90% of our trades are option selling plus the stock investment or swing trading. So right there you understand that the option sellers are the people who make the money in a consistent manner, because it happens every time we know something for a fact. That time decay in the options will go to 0, right? So I want to start at a 101 basics, then we'll go intermediate and advanced. Don't forget also If you go here on YouTube and you look for credit option strategies, 5 years ago in 2012 or 2000, what was that? 2013.
How much?
I went with my co-ed trader. We were invited by the Real Traders webinar community. And what happened is we did an hour, 38 minutes event on options credit strategy. So if you want to learn about credit spread options trading strategy or go deeper on what I'm going to share with you today, that hopefully will be very helpful and help you think differently on your wealth. We had done this event. We had 63,000 views, 225 likes, 19 dislikes. So I'm guessing that this video resonated with people, with Kevin, to help traders and investors and income traders that wants to invest and trade the vertical spread and the credit spread option strategies, as one of their most consistent go-to strategy to create weekly income and monthly income. Okay, so I urge you go on YouTube, credit spread option strategy, look for the credit spread options trading strategy, part 1, Real Traders webinar, if you want to go deeper. Okay, because I want to make sure that everybody tonight can follow the discussion. As a 70 to a 65% chance of success by expiration. The Iron Condor Butterfly has a 33% chance of success, and the credit spread has a 70% chance of success. That compares to the 50 or 40% chance of success that you have with directional. You buy a stock right away for a day trader, and this is why 90% of the day trader lose. It goes up, boom, you lose money. It goes down, you lose money, right? Whereas this credit spread strategy I showed you, whether the current price CP is right there, you construct resistance and support on your chart. So long it's below the X's or above the X's, you make money, whether the market goes up, sideways or down, within the break even. So let me show you an example. Okay? So first, your first step before you do a credit spread to understand where you have the highest probability of success is to have very good support and resistance trend indicator. So whether you use our automation that we use for the institutions or the retail traders doesn't matter. What matters is that whatever you use, whether you use volume profile, Fibonacci, moving averages, Bollinger Band, whatever that you use, that you trust it. So here's a bell curve. A bell curve is a probability of statistics repartition. One standard deviation is a 68% chance of success. So let me show you what a bell curve is. See the top of the bell curve here? That's the current price. So let's say in my example earlier on, that's the 170 on Apple, and the fringes, right, are the big support and resistance. Some people look at the delta for 3 standard deviation or 2 standard deviation, but the point of the matter is you get away from the current price. So let's say on the resistance side, I told you 190. Let's say on the support on Apple, you would look at a 140, 120. So knowing that now, you can construct smart selling of options, and the credit spread is the best option strategy because you sell a call and you buy a call above, or you sell a put and you buy a put below. Okay, and I'll show you exactly everything when it's bullish or bearish. But right now, all I want you to understand is you want to look at areas. That's your first step. Where am I going to put my short strike in my credit spread? And the credit spread is the best option strategies for the retailers, because if you sell naked calls, unlimited risk. Why? Because if you sell a call, let's say you think the resistance is at 190 on Apple, and you sell the call here, the Apple could go to 300. And so you would lose 110 points. This is unlimited risk selling the call. Whereas when you sell a call here, you buy a call that's at 191, you are protected. You have a risk-defined loss. This is why I like also for the retail traders and also your margin requirements. When you sell calls or naked puts, it requires a lot of margins that typically the retail traders cannot do unless you have portfolio margin. And portfolio margin is a way of calculating your trades for people that have $125,000 to $100,000 into their account. They can request what's called PM status, which is portfolio margin account, to have better leverage. But unless you have portfolio margin, it's going to be very difficult. So most retail traders or people who also that have Roth IRAs that sells credit spread for income, compounded consistent income into their retirement plan, they use the credit spread strategy or the vertical spread. So here you got to look at support and resistance or standard deviation. A standard deviation, when we talk about 2 standard deviation, by the way, for the conversation, is 95% chance of success. When you talk about 3 standard deviation, is 99% chance of success. And again, that would be selling super wide credit spread. They call that the poor man's credit spread or vertical spread. Or you would have to sell naked to be at those standard deviation. And usually the way you do that to get any income is to have portfolio margin. Okay? So now let me show you. The next step is to understand how to structure a credit spread. We're going to look at this. The retail tool, step 1. We look at support and resistance. You go to your charts, you look at important support and resistance. I'm looking at a chart on the SPY. Current price is going around the caution zone sideways around the 275, 280 there. See, something like this, 279, 276. This is where I come with my X and say, where's the top day trading zones? 281.5. So I want something above. See, I look at our resistance. You would have to look at your resistance. Create a safety of margin. I call that a safety of margin, like Warren Buffett always talks about a safety of margin above this 281.5. And so I would look at the next option strike that has the most open options and open interest, where there's a lot of volume, where institutions are selling. They expect this resistance to hold. And then I'm going to bet on the trade that goes back down, where the market goes back down and is going to stay below that strike. So I'm thinking 285 right now. So let's go to the option chain and let's create our first credit spread together and look at the risk. So I'm looking at the 285. Right click. If you are on Thinkorswim, you look for the credit spread, vertical spread strategy. It's called a vertical. You sell the 285. You buy the 286 for 18 cents. So what does that mean? It means that you are receiving a credit right now of 18 cents. 18 cents on a $1 wide, 285 minus 286. 285. No. 286 minus 285 equal 1. That $1, right, is the width of your, how wide your credit spread is. This is a call credit spread, which means this, by the way. It means that if my 285 strike is what I'm looking for, so look with a pen. I'm looking at the stock, remember, to stay below this 285, the short strike. Always remember that the risk is on the short strike. So what I'm doing is I want the stock to stay below 285. I make money if the market goes down from there, sideways from there, right? Or even up from there, so long it's below the 285 plus the premium. The premium I'm getting for selling this credit spread is 18 cents. 18 cents divided by the $1 width is giving me an 18% rate of return. And all of this in 24 days. So just to put some perspective, some people might say, hey, this is crap, 18% in 24 days. Well, remember, if you compound like Warren Buffett, who has compounded for the past 40 years at Berkshire Hathaway, 20% every year on $5,500, you'll get $1.4 million. So let's go back to the calculator because this is super powerful. Okay? Remember, I showed you that 20 times. If you look at this slide, $5,500 invested in a Roth IRA with $5,500 addition every year, you max your Roth IRA for 20 years, a 20% rate of return, the Warren Buffett way. Rate of return on 1 year, you have $1.4 million. And that's the magic of compounding, and it's a fact. So your own race here, it's creating two pyramids or three pyramids of success. This is what we do, right? And this is the logic of the credit spread and how you are going to use it and smash it for your long-term investment. Let's say you get that trade here, you make 18% in 24 days. Guess what? You take that money and you put it here. You reinvest into your long-term investing. You know, your Apple, your Baba, your Facebook, your dividend plays, your compounded in your retirement plan, etc. with asset protection component and tax efficiency, right? That's the key, is to use this day trading or position trading income with high probability of success and reinject them into your long-term investing. That's how you become very wealthy. It took me a lot of years, guys, to do that. You know, the guys who stay here only, you are meant to blow up. You will blow up. You will be part of the statistics. Don't do that. We all have been there. We've all suffered just putting all our money here. Don't do that. Be the guy who listens from someone. Take it from someone who's done it for 24 years. Take the profit, the consistent income profit reinjected here, and here you have 10 years, 25 years in front of your compounded power, right, with asset protection and tax efficiency to kill it. So, if you go back into that cold credit spread, step 1, we looked at support and resistance. Step 2, we created a safety of margin. Step 3, we went at the 285, 286 and said that in 24 days, I can make 18% return on my money. This is pretty good. And if you know anything about deltas, this thing has an 18 delta here at the 285, which means that there is an 82%, the inverse, 82% chance we stay below this 285 by expiration. So, a couple of cool things here. Day trading zone says 281, 282 right there, right? But look, I created a safety of margin by another 3 points, and I went when there's a lot of open interest, where a lot of institutions are piling and will defend the 285. And that's it. And where I have an 82% chance of success on this trade to make 18% on my money in the next 24 days. And this is pretty cool. This is where you start trading like a professional. This vertical spread options trading strategy, credit spread option strategies that you are looking here for consistent options income, right? It's totally different than put and calls options, directionals, where 90% of the people lose money. And I really want to bring that point home as I'm going to go deeper and deeper. I'm going to make more and more vertical spread, how-to videos, and credit spread videos, and iron condor videos. So what is an iron condor? An iron condor would be to box on both sides. So let me show you. An iron condor would be, we do a call credit spread at the top. So here we would do, we do the 285, 286. Remember, we sell the 285, we buy the 286 calls. So it becomes a call credit spread. And here we could do the same on the bottom. If the bottom is 271, let's say we sell the 270 or the 265. Yeah, so I could sell the 270 by the 265, 5 point wide or 1 point wide. I could do 270, 269. So if I do a put credit spread here, I could box, I make money the same, 3 ways. So long I stay above the 270, it goes down, I make money. It goes sideways in a range, I make money. If it goes up, I make money, especially up, because that's a bullish strategy. That's what we call a bull put credit spread or a bull put spread. So I'm going to show you how you calculate max profit, max loss, and break even on those credit spread. We'll look at the risk graph. So let's go back to our example on the SPY ETF. We sold the 285 at the top and the 286. So let me show you why it's called a bear credit spread. We sold the 285, bought the 286. Call. One contract here, one contract here. By the way, one contract equal 100 shares. You know, you have to multiply, not 100, so, but you have to multiply, it's 100, okay? So remember, one contract on 18 cents, you would make about $180, okay? If you were to get the entire 18 cents. So we sold this for 18 cents. That's called your credit receive. Your credit receive is your max profit. The max profit that you can make is the credit receive. Why? Because this is a bearish strategy. We want the stock to stay below 285. We say we are going to make an assumption at 285, 286 that we are going to stay below the 285 by expiration in 24 days, date to expiration. And meaning what? If the stock goes down towards the bottom of the support here, what happened to the calls? The calls premium are going down. And what we do when you sell options, credit spread is like shorting. You sell at 18 cents, that's what you receive, and you want to buy back your entire credit, let's say for 5 cents. So if you do that, sold for 18 cents, now at the support or close to expiration, it's worth 5 cents, it's worth nothing, you made a 13 cents profit, right? And this is how you make money. This is a call credit spread. It's a bearish strategy, right? Or a bear call spread. You can call it as you want. Me, I call it a call credit spread. Some people call it bear call spread. Some people call them a bearish vertical spread. So let's go again. Maximum profit. It's your credit. Your maximum loss is going to be the difference between the strikes minus the credit you receive. So let's go in our example. We had the 286 in strikes minus the 285, right? Minus the credit you received, the 18 cents in our example. Guess what? That means that your maximum loss is 1 minus 18 cents, which is about 82 cents. So people are going to say, hold on, Mark, my max loss is 82 cents. My max profit is 18 cents, the credit received, right? So how is that a good strategy where I risk 82 cents to make 18 cents? Because your probability of success. The fact that those strategies, those credit spreads have 68% chance of success versus a 40% chance of success or 50% chance of success when 90% of the people lose in options trading calls and put directional. This gives you a 68% chance of success, and in my example, I look at the delta tonight, it gives you more precisely an 82% chance of success as I showed you. So what you're doing here, yes, your risk reward is not great, but your probability of making consistent, and this is the key word in this strategy, consistent amount of profit, weekly and monthlies are life changers. You know, what would happen if you could make an extra 180? If you had 10 contracts, that would be an extra $180 a week just on one contract, on 10 contracts, you know, times 4, that $720 of consistent income for the month. For someone who is younger, times 12, that's $8,640. That pays for your Roth IRA. That's my point here. That is your Roth IRA, guys, in the long-term investing pyramid of what we do. We do long-term investing and income in trading. This is where the money is made. This is where you have to think wealth differently. Actually, you don't know. It's not automatic. Just take a snapshot of that and just remember, okay, credit, maximum profit, maximum loss, difference in strikes minus the net credit. Break even for a call is the short call plus the credit. Break even for a put is the short put, you know, minus the credit received. And then you become good at this, you know. And on the put credit spread, you want the stock to go up. So let's look at the put credit spread example now. So we go back to the chart. We say, okay, below 270, we go back to the option tab, and we are going to look at all the options interest and say, okay, where there's the most options interest below the 271 DTZ, and look what we find. We confirm just a little bit of a safety of margin. You know, we could sell this 270, there's 12,000 contract there, or maybe can we create a better safety of margin and go lower, maybe at 265, but I suspect you're not going to get a lot of premium. Let's look at 265. We sell the 265. Say sell vertical 265, 264. Do we have enough premium for 24 days? And the answer is no. That would give you an 8% return on your money. By the way, 8% return on your money is 4 times better than what the bank is giving you. But I suspect if I go a little further along and I go maybe 58 days is a little long because there is a time decay that starts at about 45 days. On those, you want to stay below 45 days. 45 days or all. But I suspect if you go a little further out, you would see you get much better rate of return, like just to show you. I would not typically do 58 days, but just to show you. Look, if you go to the April ones, right? The April 18, look, I make 15% return on my money. 15% return on my money with 12 points buffer on SPY, which is 120 points buffer ES or 120 points buffer SPX equivalent. Okay? And you make 15%. So I could argue this much. If Warren Buffett, the best investor of all time, that compounds at 20%, that can change your life in 20 years, if you compound 20% every year, that's really your goal. And you can make 15% return on your money, statistically wise, in 58 days, I could argue with you it's a very good rate of return. Because if you could do that 2 or 3 times a year, you are golden, everybody. You know, you're golden. You have rate of returns that could beat the best investor of all time. Reinvest those, you know, this is more aggressive strategy, and you reinvest those profits back into your long-term investing. And this is what I was trying to do tonight to really help you guys understand one of the best option strategies for consistent weekly income and monthly income. The credit spread, vertical spread, powerful option strategies, if not the best option strategy, but there's a right way and a wrong way to do it. There's a right way and a wrong way to defend them, and there's a right way and a wrong way to turn your losers. And this is what we've been specialized in doing for over 16 years. So if this video was helpful, please smash the like button before I do a put credit spread, which is a bullish strategy. You know, give us a like, give us a comment. If this is interesting, what is it that you do? What is your take on the credit spread strategies? And most importantly, if you want to learn more about what we do, below this video we have one link that gives you access to free 14 days training challenge, training videos, and free training. It's absolutely free. You go to the link, you give your email, and you come to our community to understand better what we've done as at Think Wealth Differently and Day Trading Zones for the past 24 years, trading real money, real accounts, everybody. So let's go over, I don't want to leave without a put credit spread, so at least you would have seen both sides of the market. So let's go here. Let's go recap a couple of things. If I am at the top, right there, I sold the 286. So let's say the current price, let's say the current price is somewhere here. CP on the SPY, 277. We sold the 285, remember? And we bought the 286 call. And we did what we call a call credit spread. Remember, we looked for 18 cents. Now, this is a bearish strategy. So the market goes down, goes down, goes down, goes down, goes down. The 18 cents is going to go down and you'll buy it back for a profit. Okay, that was a bearish strategy, bearish. Now let's look at a bullish strategy. Let's say the market goes down like in December, right? And it comes to a support day trading zone. And let's say it comes to this 270. We do a safety of margin. Let's say we sell the 265, 264 April I just showed you. for 15 cents, which is 15% return on investment. Why would I do that? Because I create a safety of margin between my support to the next high open interest. It goes down, and now it starts rebounding. As it starts rebounding, look what happened to the puts. We go up, we go up, we go up, we go up. Look what happened. The put premiums are going down. As they go down, that 15 cents get crushed to 2 cents, 5 cents again, and we make the difference in profit. So at the bottom, you do put credit spread. It's a bullish strategy because we sell the puts and the market rebounds. Puts go down, down, down as the market goes up, and you take the difference. At the top, it's the call credit spread. We sell the calls, and it goes down, it goes down, it goes down, and we hope to make a profit here as the 285 call gets crushed to nothing, and we pocket the difference between the profit on the 285 short and the loss on the 286. And the fact that they are boxed together is an insurance so that you don't have unlimited loss like selling options naked. Okay, so this is a very, very powerful strategy. Again, here you can do the same exercise with the put credit spread. Remember, repetition makes it perfect. Step 1, look at the support, 272. Step 2, create safety of margin, 270 or 265. I want to go very far. I go at 265. I'll sell the 265, 264 April for 15% return. I go to I sell the 265 put. I buy the 264 put for 15 cents. Okay, so let's go again through max profit, max loss, break even, same as we've done earlier on. Now we go max, let me take a pink pen, max profit, credit receive, 15 cents, 15% ROI on the risk, which is 1 point, the 1 point wide here, 265 to 64. Maximum loss, again, width of the spread, 265 to 64. Bear in mind that a spread could be a 1 point spread, a 5 point spread, a 10 point spread, and be very careful because one mistake that the newbies do all the time is that they, if they do 10 contracts here on 1 point spread, they go on an Apple 5 point spread on Amazon and they do 10 contract, and the amount at risk is not the same. Here your amount at risk is 1 minus the credit received, 15 cents is 85 cents, right? But you got to be very careful because if you were maintaining the size equal, this is where most traders get killed also in credit spread, and you do a put credit spread here on, let's say, something wide like Amazon, you do a 10 point wide or a 5 point wide for 10 contract here. Well, guess what? Here you make 42 cents, by the way, which is a little less than 10% return on investment. And I'll show you in another video what type of expectations of profit you should expect for your weekly and your monthly credit spread. But look here, 5 point wide put credit spread, you make only 4.2%. But look at the risk. On 10 contract is 5 points times 10 contract. Remember, you multiply, this is like 100. It's like almost $5,000 of risk minus the 420 that I receive here, the 42 cents times 10 contract. So I have $4,600 almost dollars of risk by keeping everything at 10 contract. If I wanted to keep the risk the same, remember 1 point wide, I did 10 contract, that's about $1,000 in risk. Okay, and you want to keep your risk even, so 10 contract for 1 point wide. Now 5 point wide, if you want to keep the risk at 1,000, you would have to go 2 contract. 2 contract, $500 risk, here 1,000. If you have a 2.5 wide credit spread, then you could go 4 contract and it would be $1,000 at risk. So here's the thing, your risk is constant here, but look what happened here. You change the sizes, 10, 2, and 4, okay? Be very careful of that, because this is a big mistake that the people who start with credit spread make. They don't adjust their size, and their risk becomes way bigger. So this is one of the most powerful option strategy. Again, the credit spread for income, weekly income, monthly income. If you want to learn more about this, make sure you subscribe to our channel, smash the bell, subscribe, get the bell so you get real-time notification, as I do only 2 videos a week on average or less, right? And make sure that you are on our Instagram and Facebook page, as I do daily updates, everybody, with real account, real money. We call also pre-market a lot of the stuff in our live mastery trading room. And again, most importantly, if you want 14 days trading challenge, absolutely free, 14 days like this, of knowledge that we have accumulated for the past 24 years in hedge funds and prop firms and helping traders just like you, just look at the description below and get the 14 days training challenge that will redirect you to our site. You take care, you stay safe. I hope it was helpful. This was 45 minutes. I tried to go as slow as possible, for the people who begin in credit spread or intermediate in credit spread. We are going to go deeper and deeper with the iron condors, the iron condor butterflies, the back ratio, and the defense strategies on YouTube as we go through 2019. You take care, you stay safe, and I'll see you in the other video.